I think a lot of people underestimate right now is just how much damage lots of small repayments can quietly do to their budget, because most people don't wake up one day and suddenly have financial stress. It usually happens slowly. A car loan, a credit card, maybe a personal loan, Afterpay, a few subscriptions. And individually, none of them feel that scary. The problem is when you stack them all together, suddenly thousands of dollars a month are disappearing before you've even lived. And this is what I see all the time. People earning decent money and still feeling broke every month. Not because they're irresponsible, not because they're wasting money, but because they've accidentally built a financial structure that's working against them. You might have $500 a month for a car loan, $200 for a credit card, $300 here, another $100 there, and before long you're losing $2,000, $3,000, sometimes $4,000 every month just servicing debt repayments. That's where people start feeling trapped. Because even when they get a pay rise or interest rates move a little, it still feels tight. Now obviously debt consolidation isn't some magic trick. You still owe the money. I always want to be clear about that. But when it's done properly, simplifying multiple repayments into one structured repayment can completely change someone's cash flow position. I've seen people free up thousands of dollars per month, not because the debt disappeared, but because the structure improved. Now here's the part most people miss. If you free up cash flow and then spend the difference, nothing really changes. The real power comes when that surplus gets redirected strategically, back onto the mortgage. Because mortgages are heavily driven by time. And even relatively small extra repayments can wipe years off a loan, sometimes decades. And that's the part most people never get shown. Banks condition people to think 30 years is normal, but often it's not that people can't get ahead. It's that they've got a structure that's working against them. Right now, with the cost of living where it is, groceries are up, insurance is up, power bills are up, and rates have gone up hard. So if you've already got lots of little repayments quietly draining your cash flow every month, it becomes really difficult to build momentum financially. So instead of focusing purely on the lowest interest rate, a better question might be, does my current setup actually help me move forward financially? Because sometimes the issue isn't the mortgage itself, it's everything surrounding it. The car loans, the credit cards, the personal debt, the constant repayments pulling money in every direction. And when you simplify things properly, people often feel like they can finally breathe again financially. Now, this is not financial advice, of course. Every situation is different. But I genuinely think more Australians need to start looking at their overall structure and strategy instead of simply chasing headline interest rates. Because for a lot of people, one good restructure can completely change the direction they're heading financially. So consider focusing on structure and strategy first, and get in touch with our team for a chat